Robert Maltbie. This is Maltbie's Minute on the Market from the heart of education at UCLA in Southern California with our April major market indicators and update. So here we are waiting for the fat lady to sing, to quote an old cliche, perhaps one more interest rate hike and we're done. We don't know, but it's feeling that way. Meanwhile, the market survived another hit to the body delivered by the regional bank crisis. Payrolls just came out, and so that's implying a little bit more of a slowdown with the economy. So maybe that'll create an easing by the Fed. The bear is looking long in tooth and short at the short end of his bite. The S&P 500 has just completed another successful test of the July lows at about 3,700, 3,800. And near-term Treasury bills in our forward rate indicator have plummeted lately, showing that interest rates maybe the Fed may now be behind the curve that way. Also, negative M2 growth has compounded this situation. Now, for the individual indicators, our market sentiment, negative, just not fearful enough. 4 out of 12 of our indicators, a lot of data here, are negative. The VIX and the VXN on the NASDAQ, both in the middle, slightly elevated, just not scary enough. Our bull-bear indicator ratio of the pundits is 0.4 bulls to every bear, and that's a little bit that's very much on the bullish side, but that's the only one in this category. Our technical indicators are mildly positive. 6 out of 9 of those are positive after the recent rally. The major market indices have gone over their moving averages. The liquidity indicators are negative but ready to flip. About 25 billion flowed out of ETFs and mutual funds in March. Buybacks were 19 billion, led by a 15 billion buyback at Applied Materials, and there was virtually no M&A, and new issuance was very low. But there's 5.2 trillion in money market accounts. That equates to over 20% of the domestic equity market record. Never seen it that high. That's a lot of buying power on the sidelines. So it will be hard to wait for the actual cut because of that amount of capital ready to go. Valuations, 4 out of 5 of our indicators are negative. The market cap to GDP is negative. The market cap to replacement value is also on the neutral side. Current fair value of the S&P 500 is 3750. That's about 8% down from our current levels here, about 4,100, and that's derived by a 17 multiplier on $220 of estimated earnings this year. Our proprietary excess liquidity indicator is slightly negative due to M2 declining over 2%. Earnings momentum, that's a short story. It's very negative and looking to get worse this quarter. Our monetary indicators also, I sound like a broken record here, negative. Money supply, aforementioned, negative. The term of the Treasury yield curve is inverted. That's negative. Our forward 1 year, there's a ray of hope here. Our forward indicators, where we take the T-bill, 1 year bill divided by 3 month, is 4.6, below the current Fed funds rate, showing the Fed now should be looking to cut. So this market is overvalued and vulnerable to the downside unless you're invested in the Magnificent Seven. This is a red flag. As Yogi Berra said, our favorite of baseball lore, it's like deja vu all over again. This happens time and time, and it's towards right before a sharper correction. The Magnificent Seven is up way more than the S&P. The S&P is up 7. The triple Qs are up 20%. That is heavily skewed towards these 7, which comprise 25% of the weighted market cap of the S&P 500. The Magnificent Seven is led by Nvidia, up 90%, Meta, up 76%, Tesla, up 68%, and then Apple, up 27%, Amazon, up 23%, and Google, up 17%. So these dominant tech companies have excellent balance sheets, and they are self-financing. So they provide shelter in the storm from the regional banking index crisis, regional banking crisis. On a PE basis, the Magnificent Seven appears pricey at 38 times compared to the S&P at about half that. Upon closer examination, the earnings growth of the Magnificent Seven shows that they trade at a discount to the S&P 500. When you consider the PEG ratio, PE divided by growth, it's 2.3 compared to the historic S&P 500 of 17 PE with 6% growth, generating a 2.8. So it's at a nice discount. The attractiveness of the Magnificent Seven becomes even more pronounced when we consider the current earnings environment. By subtracting the earnings contribution and weighting the Magnificent Seven, the result produces an S&P with negative 8% earnings growth expected here in the next 2 quarters. In summary, the flight to megacap tech embodied by the Magnificent Seven seems to be justified based on valuation, earnings, and performance. The rest of the market, look out below in the next few weeks. For more information, visit our website for a free 30-day trial subscription at singularresearch.com. Until then, and until next time, brace yourselves unless you own the Magnificent Seven. Robert Maltbie with Singular Research.